Good afternoon, everyone. Welcome to the session, our session, How Are PE Firms Enhancing Portfolio Company Performance? Look at my amazing panel. I'll introduce them to you. Starting from my left, Lawati, founder and CEO of Aleph Capital. Then we have Kåll, CEO of Capman PLC. Bob Diamond, founder and CEO of Atlas Merchant Capital. Nasrallah, executive chairwoman of De Novo Partners, and Henry Zhang, president and managing partner of Hermitage Capital. There are a lot of things to talk about when we talk about PE firms, but I will start by asking you, when you look into the market today, what are you looking for? I'll start with you, Huda.
So we run a private equity fund that's focused on the GCC and the growth market, which is a big gap. There are not a lot of people focus on that, because the gap we see in this market is not just about funding solutions for businesses that are mid-sized and looking to grow, but actually the skill set needed for these companies to scale up. Because this is the stage that with companies kind of plateau out, the one-man show or 2-3-man show doesn't really work anymore, and you need to start investing in systems, in people, in talent, and building up the organization. So we're looking for well-performing businesses with strong track records, strong teams that we can back for the scale-up, and we reciprocate by giving them the time and actually investing in the J-curve to create value.
Is it different for different sectors?
Is it for me?
It's for her. It's for you.
I think it probably slightly can vary, but I think in general, when we look at the market now, so we're a Nordic private equity firm. We invest across private equity, infrastructure, real estate, and actually natural capital as well. And I think there's two things that makes the market really interesting at the moment. It's an extremely good time to do investments. The best vintages of funds are made now because the valuations...
It is a good time.
It is a really good time.
Although it has gone down this year.
But that actually means there's investment opportunities there, that if you know the market, if you know the local conditions, you can really find good quality companies as attractive valuations right now. And we do a lot of transitioning, so green transition, so not necessarily sustainable green companies when we go in, but our work, value creation work, is really transitioning them to sustainable companies, and there's a lot of demand for that as well. So we see them being much more valuable when we look at an exit than when we now go in. So really interesting times, I would say.
So you also still think there's opportunities?
Our investment activity has stayed basically on the same level this year as if I look at the median for the last 10 years.
Bob, is it across sectors, what they're saying, if you agree with them, or do you have a different point of view?
I think in our focus is financial services. Mm-hmm. Very much the developed economies, US, UK, and Europe. Every time we look for an investment, we have perfection, which we rarely get. But perfection is, a company with a unique position, strong leadership, profitability, and to us, the most important thing is a willingness and ability to grow. Mm-hmm. And that's where we think we can really differentiate ourselves, is by helping guide them, not in an executive way, but in a very, very positive, active, ambitious way, mm-hmm. to help them grow, whether it's talent, whether it's through new geographies. If I can just say one more thing on that. After spending since 2008 looking at anything outside of banks, because mm-hmm. the best opportunities were away, right now, we think the single best opportunity in financial services is banks. It's in the US, and it's the 4,500 smaller, medium-sized regional and community banks.
Even after what happened last year with
Especially because of what happened. It's going to foster the need, the solution they bring to small businesses like ours is tremendous. So they're necessary, but 4,500. And I think over the next 3 or 4 years, it's going to be profound as we hopefully very peaceful, very constructive consolidation down to probably 1,000. And I think that will be so impactful on the overall U.S. market.
I mean, I would really love to take that point further with these small banks, but let's move on, and maybe if we have time, we'll get back to that. May, you have just completed recently another deal this year that was huge. What are you looking for when you look at the market, at the scope, and at what's in the market today?
Sure, thank you. Well, unlike my fellow panelists, I think I'm the only current investment banker in the room. So we do a lot of advice for M&A transactions, and a lot of the counterparts for the transactions that we're doing have been private equity firms. And I know that we're seeing that in the US and in other parts of the world, we're seeing trending downwards in terms of PE investments. Here it's been trending upwards. So the recent transaction that we've done, Brookfield came in and underwrote a $2 billion preferred equity investment into GEMS Education, and they took out CVC, who was there before them. So we're seeing a lot of these activities happening over here, and more recently also Network International got taken out from the public markets in the US by yet another private equity, and again, Brookfield in that situation as well. But I couldn't be more excited about the set of opportunities that we see around the region, and the fact is that there's plenty of opportunities in this country, in this region, that we haven't seen in the past. So I'm quite bullish about what the future would look like here.
Bob mentioned that there's focus on developed markets. Henry, let me ask you about your interest coming from a Chinese perspective. Would you be interested in this scope, in this market, or also the opportunities are yet to be found in China?
Right, I got some of the diversity on this panel from Asia, but we actually run a global fund, so we actually look at,
to all the markets.
All the markets, not just China, but also the rest of Asia, Europe and US. And also we increasingly finding interesting opportunities out of MENA regions. So we look at things from a technology standpoint because we are a tech-focused private equity, right? So we look at what are the technology that's going to shape the future. I think we identify a few verticals, for example, artificial intelligence across layers, whether it's infra layer, the GPUs and the chips, but also the large language models, the applications within the AI parameters. And also we look at robotics on a global basis. We think that this amazing hardware and software combination will bring a lot of changes to the future of mankind, right? And also autonomous driving, both in the US and China. So we see a lot of exciting opportunities and transformational, that's, generational opportunities coming out of different parts of the world, but we are, have a global mindset in terms of, picking the right opportunities.
When you talk about the right opportunities, which area would you be focused on today?
Here or globally?
Globally.
I think we have done a lot of investments on the large language models already, but looking forward, I think the most exciting thing going forward are two things. One is AIGC. We think there's a lot of interesting applications, just like the early days of internet, that's going to come out of this AI transformation. We're yet to see. So we've seen the foundation layer being built with the GPUs, with the models being ready, but then it's going to be thousands, if not tens of thousands of interesting applications going to grow on that basis. That's very exciting. And the second thing is robotics. I think we're going to see a shift towards general purpose robotics, the humanoid robotics. That's also on a global basis. That's going to replace a lot of things that man doesn't want to do. For example, driving, for example, doing all the housework, which also can help a lot of housewives to actually go out there and pursue their career, right?
So the magic word again is AI this year. I think at every conference we've been to, it's always been the star of everything. So again, when we talk about AI and looking forward to generative AI, to what extent do you think, Huda, this relates to your interest in the market or to the way that you do the work? Not only if you're interested in AI firms or generative AI firms, would this affect the way that you do the work?
Yeah, look, I mean, it's a tool, and you should always maximize your usage of the tools available in the market, and we all do that in a basic way. But when I come to it from a private equity perspective and investments and value creation specifically, it comes up a lot. People love talking about AI and machine learning. The issue I see is that for a lot of businesses in this region, and even bigger ones, not just the smaller ones we invest in, they don't have great data capture systems. You cannot build AI and ML on systems that are not capturing basic data. There are businesses that are sizable, they don't have the right backends, ERP tools, BI tools. You have to invest in that, and that's kind of the role we play, is to enable businesses. What AI has done is made that, allowed us to do that faster. It's also put a lot of pressure on people. When I used to work for a conglomerate, I used to be sitting with, at my board and begging people to look into e-commerce, right? And people are not convinced. This is pre-COVID. And I think a lot with everything that's happening after COVID, now with this AI boom, is that you don't spend a lot, or you don't waste a lot of energy in convincing people. The cases
Because
made
we were
itself.
forced to do it at one
Forced
point.
to do it. The cases out there, people keep talking about the value it's created. So I think that's been really helpful. Now we have to do the right things to use it. You also have to be very clear on anything, including the use of AI, to understand the ROIC of anything you do. Doing things for the sake of it, especially when you're looking at a value creation in a limited period of time that we have as investors, people can start building Rolls Royces when they don't need it. But it's very relevant. It comes up a lot. You need to build your basic systems to ensure that you can actually use it.
Priya, you had
No,
something.
I think I can give a couple of we found some really impactful areas in really low-tech situations.
Low tech, yeah.
Low technology. So for example, one example where we are looking for tenant for properties, so empty office properties, and you basically, usually it's done manually, who do you contact, who could maybe move there, but what we have now is an application where you basically know how many kilometers companies are usually okay to move their office, and you can easily get the external data on how long have they been in their offices already, how have their development been financially and FTE-wise, so headcount-wise. So now we have a tool that's just scanning for every location we have, scanning that, and automatically picking out the companies who could be relevant and even writing the emails to contact them. So that's bringing a lot of efficiency into something that's very low-tech, very kind of manual from the start. And if I look at our own operations, we have across our funds, so more than 400 fund investors, so LPs, who all have their own, especially in sustainability, their own questionnaires that they want to fill, and they are definitely not standardized yet. But what where we're getting now is that having the data in one place, which you need, but then actually being able to automate the filling of these. So again, something that's not very kind of fancy high-tech, but it's actually freeing up time from investment teams to really then do the investment activity. So I think there's a lot of these kind of quite boring, you could say, examples, but they are super impactful.
And that is inside the infrastructure?
This one is inside our own company, and then the tenant one, works also in the portfolio company.
Do you get interest in outside providers for this, for getting this AI, or it's internal?
It's both, but we are working together with some partners.
Create an opportunity for acquiring something, no?
Good.
So, Bob, going back to the traditional angle of banking, and you still see opportunities there, would the AI and the generative AI have a place in what you look at?
Huge. I think one of the big challenges for the big financial institutions in the U.S. away from the top 4 or 5 is the cost structure of getting technology where it needs to be to compete. And this is just a great equalizer. One of the biggest challenges for many of the community banks in the U.S. Is technology, compliance with regulatory intrusion, which was triggered, as you said, by SVB. And one of the great equalizers is consolidation and AI. And I think those two things together are going to make it a far more plausible future for the banks outside of the top 4 or 5. It'll be a great equalizer.
May, what do you think?
I think we live in a brave new world where you have to adopt AI, you do have to adopt a technology for you to take that extra step and be attractive to the party that you're dealing with in one way or another. An interesting example with a recent client of ours, Brands for Less, which we finished selling a stake to TJX, the parent of TJ Maxx. One of the things that they were most impressed about, this company that was homegrown from here, is the fact that their entire back warehousing was entirely AI driven. So they would have the ability for even for you, when you take something off of the shelf, that the warehouse would know. And then there were robots that were sitting there gathering the replacement products constantly. The robots were working all the time. It's impressive to see, and it just gave them the edge up in terms of either their valuation, in terms of attractiveness, in terms of the amount of private equity firms that were interested in it, etc. So when you adopt these types of technology, you're looked at as a best in class in some shape or form, and you value added towards the party that's looking at it.
My next question was going to be, does this make you change what you look for in the market? But then your example from Brands for Less is exactly what is in the market. And it is a traditional style of business, but it has incorporated AI. Would this be something, when you look at industries in the future, would this be something that would be a game breaker for you?
I mean, I think firms and acquirers look at a differentiated company. At the end of the day, they want to get to someone that has a potential outlook for the future to be attractive, to be kind of relevant in the future. And when a fast-changing world like the world that we live in, where technology and AI has become a thing of not the future, but the thing of today, if you're not evolving with what you see today, you might end up being the forgotten one in the future. So in all of our industries, we all need to be smart about how we adopt technology and what it is that we do every day. We live it in our day-to-day lives, and therefore people have to understand that and know how to best use it. It's not a replacement, it's an enhancer. It makes one become more efficient, more productive, more capable of doing more things. And so the more that we adopt it, the more that we're going to find that there's going to be value in the future for what is created.
What do you think, Henry, moving forward from AI? We already spoke about AI. When it comes to policy and regulation and how that falls into what you do, does it also hinder what you look for, or does it affect the type of companies that you are looking at?
I think it's a good balance. I think AI needs to be regulated, right? Without that, there's risk of bad actors doing something crazy with it, because the technology itself is very powerful. Yeah. But in the meanwhile, you can't have too much regulation, right, to hinder the development of this technology. So I think finding the right balance is important. I just also want to comment on how AI is going to actually impact our day-to-day work as investors. I think there's a big gap, to be honest, right? From people what expect AI can do and then what actually the AI can do, right? If you really look at the day-to-day process, a lot of that's still on a very manual basis. Even we are AI investor ourselves. But there's some prospects we're looking that's very interesting. I'll give you one example. We have a Canadian portfolio company called Kåll. What it does is they help train on-premise. Basically, the data doesn't leave your own database on your own on your company's own data platform. They train the model tailored to your own needs based on all the data you have, and then later on you can utilize that whenever you want it, right? So the future consultant, for example, of McKinsey, can utilize all the model trained on their own premise for their day-to-day work, which is something really interesting for us.
I'm going to move to another topic, related, relevant topic, but I'll ask the question, and please, any of you who would like to answer it first. It's related to what we heard yesterday about interest rates. We were at the highest ever interest, almost the highest ever interest rate, and it started going down. And now we talk about more interest rate drops in this year, maybe once or twice, maybe 25 basis points, maybe 50 basis points at the end of the year. But what was said yesterday is that this is it. It's going to stay at this level for a very long time. We are not going to go back to cheap money and see interest rates at 2% or less around the world. This means that what you said about the opportunities being there today, that might be less. There's no cheap money. So where do you look at opportunities from here?
I disagree, because I think the time when we had zero interest rate was abnormal. We've been around for 35 years doing private equity, and actually private equity has always outperformed more when there are tough times. And I think if we go, and we should be in a situation where capital actually has a cost, because I think what that does is actually keep also PE is more diligent and focused. You should not over leverage, and you should actually focus on developing the company and driving value there. And I think for managers that really focus on that one, a 2% interest rate is not an issue. Financing is available for good companies if you take good care of those companies. And rather, I think it led to quite unhealthy practices when capital was free, and banks were actually very generous in how much leverage they gave in, and even a small hiccup led into problems. So I think where we're heading now is much more sound, and it's not going to take away. I mean, it was only 10 years that we had zero interest rate. Private equity did fantastic before that as well. So I don't think it's going to go away.
I think May has something.
If I may add to what you said, I think we've gone through an era whereby it was easy to make enhanced returns because cost of debt was very cheap. So a private equity firm, for example, would come in to purchase a company, and they would do a lot of leverage recaps, or they would look at adding debt to the balance sheet, and so do financial engineering to get enhanced returns. Maybe those days are over, but now what happens is private equity firms have to look at not financial engineering, but actually operational efficiencies and looking at enhancement of those companies in terms of where they go from here, what they could do in terms of further acquisitions, what they could do in terms of really building efficiencies into the system rather than just looking at the financial return. And then the second thing that would happen now is we're seeing a lot more of these secondary transactions taking place, whereby you can't anymore perhaps sell a company from a private equity portfolio into what could be a new leveraged acquisition. So somebody coming in, taking some equity, putting some debt, that's expensive, the returns are not there. So it encourages more secondaries. So you will always find, the financial markets are great. The whole ecosystem is great because it will always find a way for it to adapt to whatever the macro situation is. So in a high interest rate environment, there's a way for one to still make money. In a low interest environment, there's a different way of making money. But I'm not pessimistic at all for the fact that interest rates are going to continue. It maybe separates the boys from the men, so to speak. And not that we have a lot of women on the audience here, but it sort of makes you need to be that much more differentiated in your approach to how you might want to make.
I fully agree, and I think kind of real value creation has you've
back
always
to
been able
basics.
to do, or at times been able to do good returns with financial engineering, but I think real value creation has to do with really transforming the company, taking it to the next level, making it international, or just growing it.
Yeah.
Then you can get a higher valuation just because also the peer group is totally different. And I think that has to be there fundamentally. But now we're probably going to see, which managers manage also in this environment.
Absolutely.
Henry, you wanted to say something?
Yeah, I think the past few years has been very challenging for VCP as we know it, right? I think globally, right? I think mainly to do with the exit. I think because for us, like we invest in growth tech companies, and a lot of the valuation is driven by DCF valuation because a lot of them are pre-profits or even pre-revenue, right? So when you think about on a DCF basis, when you have very high interest rate environment, the cost of capital is high, and therefore the valuation is low. That's why you see like globally, there's very few good tech IPOs, not just in the US, but also in China. That kind of impact the exit opportunities for all the VCPs. But I think the worst days is over. I think the Fed has made it very clear that they will be in the interest rate cutting trajectory, even though the speed and pace, people can debate about it. So I think, the worst is behind us. And I think coming back to the earlier point, right now is a good time to invest. Okay. It's a good vintage because the valuation in the primary market is still low, but it's going to get better as we exit.
Bob, can I get your opinion on that?
Yeah, two. One is just for fun.
Okay.
You guys are showing the age gap when you say rates were at an all-time high.
Well, 20
When I
years.
started trading at Morgan Stanley,
I said
30-year
almost
bonds were 14% and overnight rates were 20%. So I do think that there is real chance of much higher rates, not in the next year or so, but if in fact inflation picks up, they are going to go much higher. But for the meantime, in terms of private equity, of course I would say this because we're focused on financial services, but you're seeing it across financial services. Higher rates are inextricably good for financial services.
Okay.
The zero rates were terrible, and you couldn't differentiate. You're seeing record earnings in the big banks in the US. You're starting to see European banks robust. You're starting to see cross-border merger discussions. This is a great environment for banks, having rates at 5, 5.5, and trending down. So when you invest in financial services and private equity, rarely is leveraged used. So the higher rates don't have a negative impact. The gearing is in the platform. Yeah. And secondly, high rates are very, very good for financial services.
So I don't want to get off topic, but you think the inflation will go back up again, will become higher again?
I think there's a risk. It depends on the election to some extent, but I think the biggest cloud, if I can just say it, is whichever way the election goes, they're going to continue to increase debt. It's close to 40 trillion. And if we think that 10 and 30-year US Treasury bonds are going to go much lower with that amount of debt outstanding, we're crazy.
So because we only have like about 6.5 minutes left, and I want to hear from all of you again, so maybe we wrap up with 3 points from each one of you saying how you see PE firms enhancing company performance. We'll start with you, Huda.
So for us, and I'll contextualize it again, we are looking at GCC growth. We actually don't look at leverage at all because we're not looking at an opportunity set where you look to make money from leverage. It's really enhancing value. What we have been focused on is, in addition to you always have, I think almost any decent private equity firm will do the governance and the improvement of basic systems, etc. But I think digital transformation specifically, I know it's a hyped up term, but honestly, it does make a huge difference. And it doesn't have to be doing something very fancy, very basic automations, very basic enhancements of data gathering. This data-driven decision making is something we focus on a lot. We see a lot of value in that in terms of value creation. I think using the fact that there's a private equity investor that to enhance your ability to recruit talent. Talent is in global shortage.
Okay, that's nice.
You do not find a lot of good people easily. In our region, historically, there's not been a lot of focus on incentives and ESOPs and sharing upside with people. Now, as talent is maturing, we're getting talent from all around the world. Talent is demanding that kind of participation and equity upside. We're seeing that as a very effective tool in value creation because the easiest thing to add value is, make somebody else incentivized to add value. So that I think we're seeing a lot of. And finally, I think leveraging the right trends for ourselves. So for us, one of the basic theses of how our strategy came up is, I'm from this region. These governments, these economies have been very, very good at investing outside and spending inside for years. We live in great countries. But I think what changed over the last 5 to 7 years is we're investing outside, but we're also investing inside. And I think seeing where those investments are going, following that trends, teaching your companies to pivot and leverage those trends is also very important.
Lessons learned, Priya.
Yeah, well, I actually gave kind of 2 points, which I think we do across the board. And one is really supporting the companies in being sustainability leaders in their field when we exit them. So they might not be when we enter. And that's both on the climate, and actually we're looking at nature positivity, not only climate, but it's also on the social side. So we're creating jobs that are sustainable, that are kind of equitable. And of course, it's a governance, which I think every PE brings there. But really doing that sustainability transition. And the other one is we look for local champions, so taking them international, and then taking them international is both using our network to help them into new countries and expand, but also put then the skills, the capabilities. It might be new people, but it might also be upskilling the people in the organization so that they can actually drive and manage an international company then.
Thank you, Pia. Bob.
I would say 2 things. And the first is very simple. Leadership matters.
Okay.
And whether it's putting the right people in place, we would much prefer to invest where there is existing strong management and leadership. If not, we're prepared to put them in place. But 2 is providing the kind of support and culture and relationship so that the leadership can prosper with our support. But it has to be support where there's very, very, very open and honest communication on the things that are going well and not going well. And then lastly, I'd say that, as an example of our partners, I've never been on the board of any of our portfolio companies. We get board positions, but I'm much more valuable, I feel, and I have a lot more fun as an advisor than as a board member.
Right.
I would say governance, discipline, enhancement of building a strategy and perfecting a strategy, and efficiencies in the system. I think a lot of times PE come into companies that are not used to having an outside eye in. And so having that ability to have an outsider sitting on a board or having someone coming in and helping them drive that efficiency and strategy and direction, et cetera, and even preparation for an IPO in many circumstances. So I think all of that continuum is incredibly important from where I see value enhancement coming in.
Henry.
I think for private equities, there are 2 things matters. One is beta, one is alpha. So beta comes from picking the right time of the market cycle. I think right now is a good time to invest and exit in the next bull market. Hopefully that's going to be soon. I think the alpha will come from, basically do your due diligence, making sound judgment on a technology shift pattern. You don't want to be on the wrong side of the technology evolvement, but also picking the right winners, the right leadership management. And also, I think from a value enhancement perspective, I think I would just want to echo one of my fellow panelists' point. I think reglobalization is very important. We're living in an increasingly divided world, but I think reglobalization is a big theme. Which is part of the mission why I'm here, to bring our portfolio companies to this region to expand and to work with and collaborate with local companies and bring synergies.
So you think re-globalization, not deglobalization,
Yes.
because deglobalization lately has been has been a big major topic everyone talks about.
It's a reglobalization with an R,
With okay.
which also means return.
But just to that point, I think that's what's creating opportunities,
Yes.
frankly, is that it's creating new alliances, new setups, new people coming in and doing things together in a way that they haven't done before, because you're trying to look at, okay, what's happening with China, therefore,
Yes.
can this region be more relevant to China? What's happening in the US, what's happening in Europe? Opportunities get created as a result of all of that.
And I think the new technology and the digital economy has actually created that sphere for us. A couple of things that you said, and I'm wrapping up now. Taking the local global, I like that point a lot, and then investing internally, because this will help us invest externally. In addition to governance, talking about governance and picking the right winners. So I think this would be a bit of a wrap up for our session. Thank you very much for being here with us today. Huda, Pia, Bob, May, and Henry. It was very nice talking to all of you. Thank you.
Thank you very much.
Thank you very much.